Good evening. You've tuned into After the Bell on CNBC-TV18 and I'm Nitya Balakrishnan. Straight then to the top story that we're tracking this evening. 5 days after RBI's Deputy Governor Viral Acharya went public about areas of differences with the government, the centre has issued its first official response. The move comes after sources tell CNBC-TV18 that the government referred to powers under the RBI Act, which have never been used before in history, for consultations with the central bank, sparking the standoff. Now, in its statement, the government said autonomy of the RBI within the framework of the RBI Act is essential. Sources also tell us that only consultations took place under Section 7 and the government never issued any directions to the RBI. Sources also tell your channel that the government referred to Section 7 of the RBI Act 3 times in letters of consultation on issues ranging from resolution of power sector loans to the central bank's capital reserves. So what exactly is Section 7 of the RBI Act? It reads, and I quote, "The central government may give directions to RBI as it may consider necessary in the public interest after consultation with the governor." End of quote. Let's bring in Shireen Ban and Lata Venkatesh, who's joining us now to discuss the current standoff and the government's response, really. Shireen, over to you first. Take us through the government statement, and is it an attempt to de-escalate the situation of sorts?
Well, that is what one would assume if we go by a plain reading of the text of the government statement. To start with, the government right at the top says that the Reserve Bank's independence and autonomy is something that the government respects, and it respects the same for all other regulators. So it's made that amply clear right at the opening of its statement. It, though, veers away from referring to Section 7, as we've been reporting, that this has been something that has been referred to in the government's communication in writing with the Reserve Bank of India. The statement is silent on whether there has been any reference, any quotation with respect to the use of Section 7. As we've been reporting through the morning, it has not been used, i.e. the Reserve Bank has not been directed by the government just yet, which is why in the morning I said very clearly that the Section 7 invocation has not happened to date. But the larger issue now is, can there be some meeting ground on some of those contentious issues? The government's view, and this is what we get from top sources, is that, look, you have to go by the empirical evidence on the ground. And even if you look at the statement that the government has issued today, it says that in the interest of, in the public interest as well as in the interest of the economy, the government and the central bank must work together. So here's the grouse that the government has. A, that not enough consultation has been happening with the Reserve Bank of India. B, that the Reserve Bank of India is not taking on board the government's concerns when it comes to MSME lending, for instance, access to credit, for instance, or even the possibility of relaxing the PCA framework, which is a matter that has now been discussed by both sides in public domain. Other issues on payment regulator, etc., things like Viral Acharya brought up in his speech, again, in public domain, where the RBI has issued a dissent and the government has presented its point of view on why it believes that there should be an independent payments regulator. But I think at this point in time, the effort on the part of the government is to try and de-escalate matters. But the way forward will be whether there can be any ground that either side cede on some of these contentious issues, and that's where this story is probably going to be headed.
Absolutely, Shireen. Thanks for bringing us the government's perspective. But to you, Lata, we understand 3 letters of consultation referring to Section 7 were issued by the government to the central bank. What exactly were these letters about, and what's the way forward, you'd say?
Well, clearly the letters contain the word Section 7. Now, if that, as Shireen pointed out, does not necessarily mean that directions are going to be issued, but even referring to Section 7 is unprecedented. Now, obviously, I don't have a Reserve Bank response to the government's letter, but sources close to the Reserve Bank, people who worked in the Reserve Bank earlier and held senior positions, see the use of the word Section 7 in that letter as a threat that it could be used. Otherwise, why should it come in a letter which only is asking for consultation on 3 sticky issues, exempting the power sector from the February 12th circular, which was the first one. The second one, seeking the RBI's capital reserves, And 3, asking for loosening of the PCA norms so that more loans can be lent to MSME and SME sectors. Now, today's effort, according to experts, seems to be a papering over, a de-escalation from seemingly untenable positions or seemingly positions where there was no meeting ground. Now, what happens in the future, we will have to see. It doesn't look like the Reserve Bank will agree to any of these, for instance, giving an exemption to the power sector, or for that matter, giving away its capital reserves accumulated over maybe 20, 30 years to one government which is going to the polls. They would expect that perhaps it should be done in a different fashion. We spoke to several experts, and their point is one way of de-escalating the capital issue would be to set up a high-powered committee and allow for a public debate, and then see whether the capital is extra and whether it can be taken, and if it can be taken, how. It certainly doesn't look like a program that can be done in 6 months. The other issue of prompt corrective action probably can be handled by the government first capitalizing the banks and thereby showing its intent, which may perhaps allow the RBI to loosen some of the rules. But from the RBI's point of view, when you looked at the previous positions taken by the Reserve Bank in previous speeches, they believe Indian banks are undercapitalized, especially when NPAs are high. Our provisioning is only 15% in the first year. The rest of the world provides 100% in the first year. So they genuinely believe these are undercapitalized banks, and therefore asking these banks to lend to risky sectors, which the NBFCs are now scared to lend to, would not be a very good idea. So at the moment, it doesn't look like there is a meeting ground. We will have to see if the government capitalizes banks or if it appoints a high-powered committee. That could be a starting point for rapprochement. All that has happened today is papering over and not any firm meeting ground.
Okay, separately, I just want to address an issue that's coming in, and this is information from our colleague Sapna Das. Sources tell her that the Coal India OFS, the non-retail portion, has been oversubscribed by over 100%, 106% to be precise. Receipts of 4,300 crore rupees likely from the non-retail portion. Good response coming in from private mutual funds. So the government, of course, retains Coal India's OFS oversubscription. Retail opens tomorrow for remaining 20% of the offer. So that's the latest there as far as Coal India is concerned. And L&T, the results flashing on your screens. Lata.
Okay, now Anisha is here. Anisha, the numbers look better than expected.
Oh, quite better than expected. The profit of 2,230 crores, of course, is an exceptional item of 200 crores. So just pointing out that, but not to take away the fact that the revenue growth has been stellar. So the company says that the revenue has seen a jump of 21% and the number has come at 32,000 odd crores. And this compares with a 29,000 crore expectation that we had. So big beat coming in when it comes to the total revenue of the company. Profits, of course, has a one-off exception, but I think even the EBITDA margin has come in much better than expected. A 5,200 crore number on the margins versus the expectation of around 3,300 crores is exceptional. In fact, the EBITDA margin has come in at 16.1%. It seems to me that there might be a bit of one-off because the numbers really look very good. As far as the other things are concerned, the company says that the consolidated order book is at 2,81,000 crore rupees. So that is also strong. The order wins are 42,000 odd crores in ranges of what we were expecting, anywhere between 40 to 45,000 odd crores. So the first look on the numbers, top line beat, EBITDA margins really strong, lived up to the expectations when it comes to the order inflows, and even the bottom line is looking good. I'll just quickly go through the infrastructure segment, which is important for the company. So there they say that the customer revenue for the quarter is coming at 15,223 crores, a smart growth of 22%. Now this is something that will go exceptionally well down with the street, because remember, we were working with a number of around just 10%. So 22% is a really good number coming in. However, a slight bit of dampener when it comes to the EBITDA margins of infrastructure segment, because there the number is coming at 6.8% versus 7.4% earlier. But given the fact that the company has reported such a solid beat on all of the parameters, this might go all right with the street. In fact, we have the actions coming in. Ranjit Sivaram of ICICI Securities joins us now. Ranjit, first look on the numbers, looks like a solid beat. Do you think there can be any one-off in these numbers?
I would like to know how much is the ex-services growth, because that is one key data point which market will be trying to look at. So that we were expecting around 6 to 7%.
Well, Ranjit, I'll tell you the infrastructure segment. I'll take time to add up the rest of it, but infrastructure segment has shown a growth of 22% and the margin has come at 6.8% versus 7.4%. Your comment on the infrastructure segment then? So
the growth has been exceptionally well, so people will be looking at like the margins have come down. That is something to be worried about, but again, like how the working capital has stacked up.
Okay, and I'll just quickly read through company's outlook as well. The company says it's backed by all-round capabilities, and they're saying they're continuing to focus on operational excellence and cost competitiveness, and it's still committed to improve the shareholder returns. So similar statements coming in from the company. But I think we have Mayuresh also joining us on the line. Mayuresh, your first, took a look at the numbers. Everything looks much better than what the street estimated.
Seems to be the case, Anisha. And what has happened in the infrastructure segment, the lower margins are a mix of jobs under execution and some cost escalations that they were encountered. So I think that is the reason for lower margins in the infrastructure. But yes, I think on the face of it, the orders that they won, the consolidated order book at 2.81 lakh crore, and again the bottom line growth. Obviously, there is an exceptional item there, but even if you account for that, I think it is still better than what the street had anticipated.
Yeah, Anisha, I just want to ask you about the order book. I mean, this is a fantastic growth of 46%. So that not only is there a stellar performance in the quarter under review, but do you think that order inflow growth of 46% sets the stage for similar growth in coming quarters?
Well, yes, though with a slight bit of caveat there, the management has been saying that this year is going to be front-loaded given the elections. But nonetheless, the company had a guidance of 10 to 12% when it comes to the order inflow growth. And given the stellar number that we have seen, the asking rate might just be paltry 2-3% for the rest of the year. Though, yes, Q4 is seasonally very strong for them. And if they're doing this kind of number in the first quarter itself, which is seasonally not that strong, this comes as a very big positive. And I was going through the segments as well. There is positives all around. The development project loss has just come in at 46 crores. If you look at the hydrocarbon segment as well, the profit has jumped to 300 crores. And by profit, I mean the EBIT number coming in. IT and financial services we knew is what will lend support. But separately, even the infrastructure segment has done well. Ranjit, coming back to you in terms of the stock price, how do you see the stock reacting tomorrow? Yes, it's already up around 8% this week. But do you think that with the stellar numbers we have seen, we might see more upgrades as well as the stock will react quite a bit positively?
Yeah, given the better than expected execution, especially in the infrastructure, we believe that stock should react positively because nobody was factoring such kind of a growth under infrastructure. Now, if you now put this in perspective with the ABB and also Cummins, we are seeing that the overall infra and the other growth is much far ahead of what the street were expecting. Because both these companies also reported 30% growth in their overall revenue. So that infra segment is doing well.
But the other point that I just wanted to bring up is that in terms of the international revenue, that has contributed just around 14-15%. Sorry, it's the international orders rather, which has contributed just 14% to the overall infrastructure order inflow. Do you think now that is the trend that we are seeing, that domestic execution is really picking up pace, but international is slowing down quite a bit?
Yeah, that the similar trend we had seen with the other capital goods companies also, which had reported stellar numbers, that we have seen the domestic infra and domestic execution is picking up. So this is also one thing which a lot of management shared, that since it's an election year, the focus will be more towards execution this year.
Right.
And again, that front-ended order booking should give the comfort that the company can manage to.
Well, Ranjit, I'll have to stop you there. The management is detailing out the numbers, so we'll cut across to that.
Splendid set of results for Larsen & Toubro for the period ended September 2018. These results are significant in the context of the challenging environment in which infrastructure and capital goods industry is operating in today. Macro headwinds, rising oil prices, volatility in commodity markets, volatility in stock markets, volatility in currency markets, liquidity crunch, the latest. There are enough and more reasons for companies to underperform to their potential. But it is to credit of L&T and its competent people, dedicated people, that we have been able to report satisfactory results, braving all of these headwinds. Having said that, let me substantiate my statement by looking at the results that we are talking about. Before I get into the results per se, the usual disclaimer on forward-looking statements that will be made in the course of this conversation. The presentation will start with the highlights of our Q2, and while we talk about Q2, we'll also talk about the half-year position. As far as Q2 goes, I think the order inflow is up by 46%. One of the rich quarters that we have had in terms of winning orders. These orders have been won against stiff competition. As you know, opportunities are limited. So to have such a massive order win requires a lot of technical competence and capability. Order book consequently has grown by 9%. We will see the size of the order book and its composition a little later. Revenue, refreshingly, is up by 21%. We've always been speaking at these meetings about the headwinds for execution and how we often are required to punch below our weight because of impediments in executing projects. Not that all the impediments are gone and not that this is the new norm, but the fact is over the last 3 months and last 6 months, we've been able to find ways to make sure that the projects that we are working on moves forward so that we could have a healthy revenue growth. More importantly, the revenue growth has come along with improved profitability, and that is the reason why you have EBITDA growing by 27% for the quarter ended September 18. And profit after tax, thanks to the growth in revenue and thanks to the growth in EBITDA, has also moved up handsomely by 23%. These numbers are comparison of Q2 numbers over the previous year's second quarter. Looking at the order inflow, the orders that the company has won is 419 billion rupees, which is a 46% growth over 287 billion that it won in the Q2 of the previous year. And this growth is largely come on the back of significant recovery in the order wins in the domestic market. From 183 billion rupees, the order wins for the current year's second quarter, is 336 billion rupees, which is a 83% growth. At long last, there has been a push towards making these orders happen, and awards have started gathering pace, and we hope it sustains. International revenue, however, international orders, however, has declined by 20% from 104 billion rupees to 83 billion rupees. This was to be expected as a major international market that we operate in, namely Middle East, is going through transition, and consequently, we are becoming far more selective in the areas we choose to operate in Middle East. And the dip in the Middle East order has resulted in overall order inflow from the international markets going down by 20% for the quarter. However, we are seeding markets like Africa and ASEAN region, and we hope that a better balance we could bring about in the international order book going forward. For the half year, we have won orders worth 781 billion rupees, which is 42% higher than the 551 billion rupees that we won in the half year of the previous year. And like the quarterly trend, the growth in the domestic order wins is significant, 65% growth from 368 billion rupees to 604 billion rupees. And the international orders for the 6-month period has declined more modestly by 4% as compared to the 20% in Q2 of the current year. The growth in the orders are largely on account of the thrust that has been given for the infrastructure projects, the fact that the state and central governments have been pushing ahead on these projects, and their cause is helped by a lot of funding support that comes in from multilateral agencies. The World Bank, the JICA, the ADB, and so on, helps these projects to get to financial closure, and hence the EPC companies begin their work. Bulk of the orders, apart from infrastructure, was also coming in from the heavy engineering segment with the rising oil prices and thrust towards cleaner fuel. We see a lot of orders coming in from the refinery segment for clean fuel program. We do continue to believe that the public sector-led investments is what is holding the momentum. Private sector continues to be cautious. There are pockets in which investments are happening, but not wholesale for it to move the needle insofar as fresh orders are concerned. And we have also seen, we've had a very poor quarter two of the previous year in the power segment. The same thrust towards clean fuel, they've been ordering out by the likes of NTPC for flue gas desulfurizer, and that has given a fresh lease of life for thermal power ordering. The composition of the order inflow is 55% from infrastructure sector, which anyway is the biggest sector. And the health of this sector and the orders that we receive in this sector determines the order inflow trajectory of the company. Since it is consolidated numbers, we do translate the revenues of the services sectors as orders. Consequently, the good growth of the services sector, when translated into order inflow, accounts for 20% of the order inflow for the half-year period. Hydrocarbon has shifted gears and they've been winning some orders. Consequently, close to 10% of the order inflow is also on account of hydrocarbon. Heavy engineering, power, as well as electrical business are between 3 and 4% of the share of the order pie. And defense continues to wait for the right opportunities. So they have not been able to significantly add to the order inflow of the current 6-month period. Consequently, the order book is divided overwhelmingly in favor of infrastructure sector. Out of 2.8 trillion rupees worth of order book, 2.1 trillion is on account of infrastructure alone. We do have 279 billion rupees from hydrocarbon sector and about 119 billion rupees from defense engineering sector that contribute significantly to this order book composition. Looking at the specific numbers for the performance of the group on a consolidated basis, the revenues for the quarter ended September 18 is 321 billion rupees, which is up 21% as compared to quarter two of the previous year. And the revenue for the half year is 604 billion rupees, which is up by 20% as compared to half year of the previous year. 33% of these revenues are from international contracts that we execute, and these reflect the order book that we have on international sector at about 22% of the total order book that we saw. So until those orders are depleted, the execution flow from those orders would continue into the future quarters as well. There has been a lot of initiatives that the company has taken to improve the operational efficiency and productivity management. It is very important to do that because the markets were not offering opportunity for price discovery. So it's very important for the company to discover new lines of cost and new levels of cost. So there has been tremendous thrust towards cost optimization, process optimization, automation, digital initiatives, etc. And we see the first signs of those benefits seeping through the P&L numbers, where we find that the operating expenses have, as a percentage of revenues, dropped by 100 basis points for the quarter two and by 200 basis points for the half year. The finance charge OPEX is more in relation to the financial services business, where money is the raw material. So the finance cost incurred by the financial services business are classified as finance charge OPEX, and they are not separately reported. The staff cost is up by 20% at 46 billion rupees as compared to 38 billion and 89 billion rupees for the half year. The staff cost increase is largely on account of the staff augmentation that we have done in the services business, which are growing at a fairly brisk pace. Sales and administration cost at 20 billion rupees is up by 34% for the quarter and 32% for the half year. The sales and administration includes, apart from the business development and normal sales and administrative cost, it also includes the provisions that we make for rectification work, warranties, etc., as well as for the credit cost of the financial services business. So the increase in sales and administration cost is on account of the extra provisions that we are carrying as our revenue volumes increase. The total OPEX of the company for the quarter at 283 billion rupees is at 21% up as compared to the previous year's quarter two. And for the half year at 537 billion rupees is up by 18%. the good news for EBITDA perspective is the OPEX has increased by 18% for the half year as compared to 20% increase for the revenue. And hence you will find that the EBITDA for the half year at 67 billion rupees is up by 33% as compared to half year of the previous year. Consequently, the EBITDA margin for the quarter 2 is up by 60 basis points at 11.8%, and for the half year at 11.1%, up by 110 basis points. The finance cost represents the interest cost that the company incurs, the group incurs rather, for managing the finances. And despite tremendous pressure that is there on the financial markets, our respective treasury teams have done well to contain these costs at 4 billion rupees for the quarter and 8 billion rupees for the half year. And the cost of raising money stays around 7.5%, which is very competitive even in good markets, not to mention about the current tough markets. Depreciation amortization at 5 billion rupees for the quarter and 12 billion rupees for the half year. And then we have another income of 4 billion rupees for the quarter and 7 billion rupees for the half year. So excluding all of the exceptional items, we still have a growth in profitability because the costs have been contained and the EBITDA margin improvement stays intact. We have an exceptional item of 3 billion rupees, largely on account of a provision that we made for a bad debt being returned back because of the improved recoverability of the provision. And the profit after tax that we report is at 22 billion rupees for the quarter, up 23%, and at 34 billion rupees, up 27% over the previous year's first half. Getting on to the segment details, there is no change in the segmentation. We announced certain changes in the first quarter results about reclassification. They stay, and there is no further changes to these. Starting with the infrastructure segment, the segment revenue grew by 21%. The growth to 152 billion rupees or 125 billion rupees in quarter 2 has been largely instrumental in the company reporting a revenue growth of 22%. As far as the half year is concerned, the segment revenue is up at 273 billion rupees, up 16% as compared to the previous year. 42 billion rupees of quarter 2 revenue and 80 billion rupees of the half year revenue relate to contracts in the international markets, and they report a growth of 8.7% for the quarter and 6.2% for the half year respectively. The EBITDA margins at 6.8% for the quarter and on the half year period is reflective of the stage at which the jobs are placed and the various jobs which are at different levels of margin recognition and are not indicative of the destination margins for this segment at the end of the year. Moving on to power segment, the revenues are down by 36% for the quarter at 10 billion rupees and for the half year by similar percentage at 21 billion rupees. We've been speaking about lack of new orders in this segment. Consequently, the declining order book results in decline in the power segment revenue. The international revenues are close to 30% for the quarter and as well as for the half year. And we're executing projects in Bangladesh, and the projects are moving towards their last lap. Consequently, you see a declining trend of these revenues as compared to the previous year. EBITDA margins at 6% for the half year quarter and 5% for the half year are reflective of the competitive environment in which the business operates. It is also important to bear in mind here that the manufacturing joint ventures that we run for manufacturing supercritical boiler and turbine are not part of these EBITDA margins. They, being jointly controlled companies, are reported at profit after tax levels as a separate line item outside of the EBITDA of the segment. So if you were to include those, the EBITDA margins of this segment, speaking on a holistic basis, will look better. Moving on to heavy engineering segment, at the beginning of the year, we bifurcated the heavy engineering into heavy engineering and defense engineering. Heavy engineering essentially caters to oil and gas sector, refinery, nuclear power, etc. And we are in a good spot as far as heavy engineering is concerned because there's been a resurgence of ordering by refineries and on the back of rising oil prices. There is also a thrust towards clean fuel we are moving towards Euro 6 compliance. So consequently, reactors are being ordered out both domestically as well as internationally. And as we speak, we currently are executing orders for about 32 reactors. The shops are actually quite full. And this is evident in the revenue growth of 51% for the quarter at 4.7 billion rupees and 41% for the half year at 8 billion rupees. You do find that the international revenues have grown by 35% and 31% respectively for the quarter and half year, because we've got orders from US, Europe, we've got orders from China and Middle East. So consequently, the export order book looks very healthy and robust as we speak. EBITDA margins on the back of heightened activity and good order mix, as well as margin recognition threshold for some of these orders, moves up to 24.2% for the quarter and 29.1% for the half year. The sector has seen very tough days in the past few years. So it's actually a good relief for the people working in this sector and the capacity that we have created in this sector, that our competence is getting recognized not only domestically, but by international markets as well, as they begin to order out. Defense engineering segment, in a sense, a startup segment. It was an old activity carried on in the company, but received a new thrust and new platform. We've not won any significant orders in the current half year so far. So consequently, you will find that the revenues are flattish at 9 billion rupees for the quarter. And for the half year, however, based on the progress that we have made on the large gun program that we won in the previous year, the revenue for the half year has moved up by 9.5% at 16.6 billion rupees. The EBITDA margins of this segment, being a complicated segment in terms of...
Meanwhile, Tata Motors has also come out with its second quarter performance. Let's cut across to the management that's currently addressing the media.
Well, you can see that our aspirations are high and that we actually live our dream in PV. We are delighted with the response to the initial teasers of our next generation SUV, the Tata Harrier. In the meanwhile, it's a bit more than just a teaser, because yesterday you have seen the first real pictures, along with a picture, first vehicle out of production off the line. So while some of you might have raised a certain question mark when we made the announcement that we are going to have to launch beginning of the next calendar year, beginning of the fourth quarter of the fiscal year, if this is going to happen, that was the purpose of yesterday's message, to say, hey, it's going to happen. And if you would consider to buy a vehicle in this category, as of now it's worth to wait, because it's not that long before this vehicle is going to be on the Indian roads. So therefore, it's slated to enter the market in early 2019 as planned, as committed, as promised, and I'm sure the Harrier will rule the hearts and, of course, the roads. The feedback which we have enjoyed after yesterday's pictures went viral is overwhelmingly positive and has really led to a great motivation and boost within Tata Motors to meet customer expectations. No, it's incorrect. It's not about meeting customer expectations, it's about exceeding customers' expectations, and this is for what the vehicle has effectively been made about. Lots happening in the EV space too. We are fully geared to lead the electric mobility evolution in the country. Our market acceptance in the personal fleet segment with the recent tie-up with Cognizant is a starting step of our ambitious expansion plan. Our future product planning EV is evolving as we are preparing to develop a comprehensive range of vehicles in passenger and commercial vehicle applications. We firmly believe that the country needs a strong push on the zero-emission technologies, and we at Tata Motors have a clear sight on the bigger picture. With our unique advantage of being in the Tata Group, we continue to leverage the capabilities of the group companies to enable the e-mobility ecosystem. That's the important part. It's not about bringing something on 4 wheels or in commercial vehicles, even on many more wheels on the road as a fully electric zero-emission product. In India, The challenge is to build an ecosystem in which you can successfully sell and, even more important, successfully operate electric vehicles in the future as a positive contribution to the economy, but even more so to the environment. A quick update on the EESL front, because lots of discussions took place, and we have always been ready and available for comments and statements. And before you anyway ask the question, here it is. We have completed the delivery of the first batch of 330 Tiggo EVs, and we are on track to ensure timely deliveries of the next batch. We are very closely aligned with our customer EESL, as they are very closely aligned with their customers, because you know the end customer is not EESL, and EESL is more or less the agency in between. And in the meanwhile, our vehicles operated across the entire country, and not as it was initially intended, just in the larger Delhi region. Our approach to the future. Some of you have been present when I made the statement just recently at the SIAM event, the annual convention. Our approach for the future is about another CES, not another tax levy, so don't get me wrong. Another CES in terms of connected, electric, shared and safe. Why did we change the acronym globally used in the automotive industry, where it starts with autonomous, connected, electric and shared? We wanted to put emphasis on safe, because we do believe safe mobility is a prerequisite in India in order to really create and sustain mobility in this country, as we expect a huge growth of vehicles, as we also expect that the infrastructure is going to improve. So that means in India, we are not ready yet for the higher levels of autonomous. But we are actively looking forward to join hands with the players who are active in the mobility space. The ones who can actually help on connected, on electric, on safe, but also the ones who can actually help to jointly develop with us the service space as a key element of future mobility in India. Our commitment stands to bring a sustainable, profitable growth to the company. And to tell you about Jaguar Land Rover, I now invite my colleague, Professor Dr. Ralf Speth, to give you more of an insight in the other part of the Tata Motors Group. And again, from my side, thanks for joining. And we are going to be available after Balaji has introduced the financial side of the business for your questions. And we are more than happy to answer your questions. Thank you.